Treasury yields jumped between early December and the end of January, but we don't believe some of the ensuing fears of a more aggressive bear market are warranted. The curve steepened sharply during the decline as the 10-year and 30-year yields led the sell-off, and the 10-year and 30-year yields do remain approximately 40 basis points above their early December levels. However, yields have been largely range-bound so far this month. The sell-off finally abated as yields peaked on February 4th in the aftermath of the February 1st non-farm payrolls release. Specifically, the 3.25 level on the long bond, the 2.06 area on the 10-year note, 145 on the 7-year, and approximately 0.92% on the 5-year note all held, and the market found a bid at those levels. Those levels were tested again quite strongly last week, particularly for the 10-year note and a little bit for the 30-year bond. When that held, it set up a little bit of a double top, and there was a strong short covering bounce after that in response. In addition to that potential technical support is one reason we expect better near-term support. Treasury should find support this week from the limited Treasury supply schedule. There's nothing on the Treasury supply schedule of note except for the 10-year TIPS auction this week. At the same time, the Fed will continue its $45 billion per month round of Treasury purchases. Also, concerns about the economic impact of the looming sequester, which kicks in on March 1st if Congress does nothing to resolve the situation. That will also keep some potential sellers sidelined. Market participants are looking ahead as well to this weekend's elections in Italy with a little trepidation about the potential return to power of Silvio Berlusconi or his party. So that does have the potential to generate some safe haven flows out of European sovereign debt and into treasuries should Berlusconi or his party perform better than expected. In response, we also would expect a little better flattening activity on any rallies in treasuries as well. Among the risks, however, to that near-term outlook are, in addition to the possibility of Berlusconi's party underperforming in the elections, which could spark a bit of a relief bid for European peripheral markets pulling money from treasuries, there's also the risk of potential for any signs in Wednesday afternoon's FOMC minutes that the Fed could be prepared to curtail asset purchases this year a little bit sooner than most in the market had priced in. So while those are the risks, however, we think that the more likely opportunity in the near term is that the market maintains its technical support, that the Treasury purchases and lack of fresh Treasury debt this week also offer some support, and concerns about the sequester and the U.S. economy provide some solid underpinnings as well.